Hello YouTube, I am the accounting tutor. I create videos to help anyone studying or wanting to know more about accounting. Hopefully these videos will be useful to not only those of you new to accounting or to those of you studying accounting, but also for seasoned finance professionals. I'm here to help everyone, so if there's a video that you would like me to create, please leave a comment in the comment section. And if you like my video, then please subscribe to my channel and press that like button. And if you want to help me create future content, then please consider supporting me on Patreon. So let's get accounting. Today's video is on how to do double entry accounting. This will cover debits and credits and knowing what to debit and what to credit in a transaction. So let's start with the basics. Every transaction that occurs has at least two sides to it, and these are made up of what we've given up and what we have received in return. For example, I give up money to buy a chocolate bar, or you give up time to go to the gym. So this concept, this idea of giving something up and getting something in return is the most important part of understanding double entry accounting. That's why this is my golden rule number 1. So, the first golden rule is what we have given up must equal what we have received in return. This is the exact concept on which debits and credits are founded, and therefore, using this concept, debits must equal credits. But how do we know what to debit and what to credit? Well, before we start on that, we need to remind ourselves of a few things. In order to understand accounting concepts, you need to have a basic grasp of what assets, liabilities, income, and expenses are. Along with equity, which we won't cover in this video, they form the majority of what is in a balance sheet or P&L, or others may call it income statement. The balance sheet and the P&L make up two of the primary financial statements. Therefore, having this idea of assets, liabilities, income, and expenses is important. So what is an asset, what is a liability, and what is income, and what is expense? Why don't we start with an asset? Well, if you own it, or if you can get something for it by selling it later, it's an asset to you. Things that are assets may include cash, bank balances, money people owe you, cars, planes, boats, bikes, and all of them must be things you own. Clothes, either personal, or if you're a company, stock, and the stock could be clothes or wine or food or whatever it is. Phones and all types of electronics. This includes computers and laptops. Machinery, plant, fixtures and fittings, all of your own. and then buildings and houses that you own as well. A liability are things that you owe or that people can get money for later from you. So these will be things like credit cards, money you owe other people, mortgages and loans from the bank, and also bills and invoices which are unpaid. Now, what's income? Well, if you've earned money, or you should have earned money because you completed a service for someone, or as we get more advanced, if you've sold some of your stock, then it's income. If you've purchased something or received a service or a good for something you had previously ordered, then it's an expense, as long as the thing you purchased wasn't an asset. Things covered as expenses: cleaning services, holidays, and travel. Okay, so now we understand all of that, let's return to debits and credits. Let's remember golden rule number 1. What we've given up must be equal to what we've received in return. So let's now try golden rule number 2. If cash goes up, it's a debit. Cash goes down, it's a credit. By remembering this simple rule, you will be always able to complete one side of a double entry involving cash or something that could become cash at a later point. So I repeat, if cash goes up, it's a debit. If cash goes down, it's a credit. Let's try an example. It's been a tough week and I really need a drink, and so I buy a bottle of wine for £10 in cash. How do I account for this? If you don't drink wine, replace it with any type of beverage of your choice. But let's go through our rules first. So rule number 1, what I've given up must equal what I've received in return. Well, let's put this in context. I've given up £10 in cash and I've received a bottle of wine in return. Now let's go to rule number 2. If cash goes up, it's a debit. If cash goes down, it's a credit. Let's apply it in this context. My cash has gone down because I've given up £10 and received a bottle of wine in return. Therefore, I know straight away that this is going to be a credit to cash, and the value is for £10. So now we can apply rule number 1 again. What we've received in return must equal what we've given up. So debits must equal credits. So if I have credited cash for £10, I must be debiting something else for £10. In this case, I have received the wine, so I debit wine £10. If I were a business and that wine is what I sold normally, then that would be my stock. So overall, what have we done? We've gone credit cash, £10, debit wine or stock, £10. Let's do another example. I sell my clothes for £50. I've had a little clear out. I'm selling my clothes for £50. Let's go through golden rule number 1. So what I've given up equals what I've received in return. I've given up my clothes and I've received £50 in return. Now let's go to golden rule number 2. If cash goes up, it's a debit. If cash goes down, it's a credit. My cash has gone up because I've received £50 cash for my clothes. Therefore, applying rule 2, I must go debit to cash for £50. Now let's apply rule 1. What I've given up must equal what I've received in return. Debits must equal credits, so I have to credit something for £50. So I credit the clothes, which were an asset to me personally. Now, if I'm a company that sells clothes, then the clothes are stock, so I'd credit stock. But actually, it's a bit more complicated than that. So for more advanced students, if you're a company selling clothes, then you would actually go debit your cash for £50, credit your sales or income for £50, then credit your stock for £50 and debit your cost of sales or expenses for £50. But for simplicity's sake, we'll cover that off at a different point. For simplicity in understanding double entry accounting, we're debiting our cash £50 and crediting clothes for £50. Good. So why don't we try a little quiz? You can pause the video after these 3 questions after we've gone through these 3 questions. Take your answers down, and then I'll go through the answers one by one. So question number 1. The bank has charged me an overdraft charge of $5. It's reduced my bank balance by $5. What's the double entry, debit and credit? Question number 2. The bank has given me interest on my cash balance of £10. My cash balance has gone up by £10. What's the double entry? And question number 3. I have paid back a friend £20 cash that I borrowed from them. What's the double entry? So you can pause the video now and then click play when you want to go through the answers. Okay, so let's go through answer number 1. My bank balance has gone down by $5 because of an overdraft fee that the bank has applied on my bank balance. So cash has gone down by $5. Let's apply golden rule number 2. If cash has gone up, it's a debit. Cash has gone down, it's a credit. Cash has gone down by $5, so I credit my cash by $5. Now let's apply golden rule 1. Credits must equal debits. So I've got a credit of $5 to cash, so I have to debit something $5. So what do I debit in this case? Well, I have paid $5 to the bank. Why? Because the bank have given me an overdraft, they've given me a service. And therefore, because I've got a service in return, it's an expense. So I debit an expense $5. So overall, credit cash $5, debit expense $5. Okay. Now let's go to answer number 2. My bank balance has gone up by £10. This is because the bank has given me interest on the cash that sat in the bank account. So cash has gone up by £10. Let's apply rule number 2. A debit to cash is an increase to cash is a debit. A decrease to cash is a credit. Well, cash has gone up, and therefore it's a debit to cash for £10. Now let's apply rule number 1. Credits must equal debits. We've already debited cash £10, so we need to credit something for £10. So what do we credit in this scenario? Well, I've earned £10 in return for the bank being able to use my money. And so because I've earned this money, it's income. So overall, I go debit cash £10, credit my income £10. Question number 3. I paid a friend back £20 that I had borrowed from them. So cash has gone down £20 because I've given it to them. Let's apply rule number 2. Cash goes up, it's a debit. Cash goes down, it's a credit. Cash has gone down by £20, so I credit my cash £20. Let's apply rule number 1. Credits must equal debits. So the credit of £20, there must be a debit of £20. What is that debit? Well, I have paid £20 in return for settling a debt that I owed someone. Yeah? So remember, what we have given up must equal what we have received in return. I've given up £20 to settle a debt I owed someone. Some money that you owe someone is a liability. Therefore, overall, credit cash, £20, debit my liability or payables, £20. So let's move on now. What happens if a transaction does not involve cash? This is where we have to apply golden rule number 3. And golden rule number 3 is, when cash is not involved in a transaction, try and make the transaction involve cash. Okay? So I repeat, try and make the transaction involve cash. So remember, when cash we have to pay out at a later date occurs, it's called a payable, a liability, and when we're due to receive cash at a later date, it's called a receivable, as an asset. Okay, so let's put all of this into practice. I have bought a computer on credit, payable in 6 months for £50. It's a rubbish computer, that's why it's only £50. Okay, but I bought it on credit, not for cash. So let's go through it one by one. Golden rule number 1. What I've given up must equal what I've received in return. I have given up £50, which I will pay later, and I've received a computer in return. Now, instead of going to rule number 2 first, we're going to go to rule number 3. When cash is not involved, pretend that it is. So, currently, it's £50 to be paid later. Yeah, a payable. So let's replace that. Let's change the £50 to be paid later to £50 cash. And let's repeat golden rule number 1. I've given up £50 cash and I've received a computer in return. Boom. You know now what the debit and the credit is, because we know from rule number 2, if cash goes up, it's a debit, cash goes down, it's a credit. We have given up cash of £50. Cash has gone down by £50. Therefore, it has to be a credit to cash of £50. Okay? But we know it's not cash, and because it's money that we'll actually pay later. So at this point, change the word cash in the double entry to payables, the word that it should be, because we owe that money later. So it becomes credit, payables, £50. And then applying rule number 1, debits must equal credits. So we know it's credit payables £50. We have to debit something £50. What have we received? We've received the computer. So credit payables, debit computer, PP. Okay. And lastly, what happens if there is a transaction that does not involve cash now or in the future? This is a tough one, and we'll cover this in a separate video. But the answer is something else must be going up or down in value if cash isn't involved. And remember, if something is going up or down in value, that means that in the future that thing could be sold for cash, higher or lower. Yeah. So if an asset goes up in value, it means that the cash you may get for that in the future is going up in value. So you can apply rule number 3 and say assets going up in value, replace asset with cash. Yeah. So cash goes up in value. We know that if cash is increasing, it's a debit. So we're going to go debit the asset. Yeah. If a liability is increasing in value, so if it's becoming larger, then it's a credit. Now, why is this? A liability is something we owe, right? So if I owe something and it's getting bigger, that means the cash that's going to leave me is going to get bigger as well. So what does that mean? That means that it is a credit because cash is decreasing. Okay. Then we go into the income statement. If expenses go up in value, it's a debit. Now this is the other side of the coin. Okay. Why? Because if expenses are going up, it means my cash is going down. Yeah. So if cash goes down, so I go credit cash, that means my expenses will be debit expenses. And then if income goes up in value, it's a credit to income. Okay, but we'll cover off the P&L in more detail later. If you focus on the assets and liabilities and applying rule 1, 2, and 3, you'll get the majority of your answers. So lastly, I want to thank you all for watching the video. If you enjoyed the video, then please like it and subscribe to the channel. I'm going to try and do a video every week, and please leave your comments in the comments section about any topic that you'd like me to cover. And like I say, please consider supporting me on Patreon. The website's www.patreon.com/accounting-tutor. Thank you very much for all of your time, and I hope and wish you all well. Take care.